Today, we're going to investigate the best Fidelity funds to build your financial freedom for retirement. So stay tuned for the full episode. Welcome back. This is Richard with Wisdom Investor. On this channel, we investigate Social Security, when to retire, investing for retirement, how much money you need to retire, and much more. And today, we're going to explore the Fidelity funds. Fidelity has hundreds of different funds. And what we're going to do is narrow this down to make the picks a little bit easier. So we're going to share some ideas here I think that are going to be very helpful for you. Now I know we have many people that watch this channel and they've built a large retirement nest egg through some basic principles over time. And one of those principles is save anywhere between 15 to 20% of your income, invest regularly in a 401k or 403b employment plan, and number 3, control your expenses. Now, if you want to accelerate the process and build your retirement nest egg faster, then we want to save more money, 20 to 25% of your income or more. Again, take advantage of a 401k or 403b plan through employment and reduce your expenses to a minimum, but don't destroy your life. We're looking at a listing of the Fidelity funds. Now, they have hundreds of different funds, as we mentioned earlier. What we have done here, we've narrowed the search down so that a person is trying to build their retirement nest egg over a long period of time. We found some excellent funds that would do that job. And then for the person that needs to accelerate their savings and their investment growth, we've picked out some funds that would match that situation also. This is our sample portfolio for a person that wants to build financial freedom over time. We have 3 different funds in this category. The first one here is the Fidelity Blue Chip Growth Fund. Over the last 10 years, it's had a return of 16.31%. Here's a look at the Fidelity Blue Chip Fund. Now this fund is a little bit more aggressive than the other 2 that we're going to look at. The Fidelity Blue Chip year to date is down 23.88%. No one can guarantee future returns. Minimum investment here is $0. The beta, as we talked before on other videos, is 1.14. When you compare this to the S&P 500, this is a little more aggressive than the S&P 500. The expense ratio is 0.79. Most of the top 10 stocks here are technology stocks. There's 212 equity holdings in this entire portfolio. So you can see you're being well diversified. Now, typically what I like to look at is the top 10 holdings. In this case, you can see 49.11% of the total assets is in the top 10 holdings. The second fund we have in this portfolio is the Fidelity Growth and Income Fund. The last 10 years, up 12.25%. If we look at the details here for Fidelity Growth and Income, this is less aggressive than the first fund that we looked at. Now, year to date, it's down 2.11%. The beta is 0.93. Again, when we compare it to the S&P 500, the S&P 500 has a beta of 1.0, so this is less aggressive than the S&P 500, has an expense ratio of 0.59%. If you look at the top 10 holdings, you can see it makes up some of the best large blue chip stocks in America. 39.06% of the total assets is in the top 10 funds. By the way, if you have any additional comments or funds that you prefer, leave a comment. They're most welcome. The third fund to build your financial freedom over time is the Fidelity Equity Income. Over the last 10 years, up 10.7%. The Fidelity Equity Income is a little less aggressive than the first 2 that we've looked at. Year to date, down 3.4%. Of course, everything in 2022 is down. Less aggressive than the S&P 500, and the expense ratio is 0.57. 23.16% of the total assets is in the top 10 holdings. And you can see here, these top 10 holdings are slightly different than the first 2 funds that we looked at. 121 equity holdings, so you're very diversified. Let's say you had $100,000 to invest and you wanted a 60 equities to 40% cash portfolio. So your 60% equities would be these equities that we're showing here, and your cash position would be separate to this. As far as investing in the markets right now, I would only be using a dollar cost averaging approach. where you put a portion of your investment in each month, say over a 12 to 18 month period of time. When we get a clear picture of where the market's heading, then we could do some lump sum investments. Now, for an investor that wants to grow their investments over time, here's some additional funds that a person could use. Fidelity Small Cap Growth, Fidelity High Dividend, Fidelity Real Estate Investment Portfolio, and the Fidelity International Discovery. These are all excellent funds. Now, if you're investing over the long run, but you want to accelerate your growth a little faster, then you could use a higher percentage of the Fidelity Blue Chip Growth Fund instead of the growth and income and the equity in. We're going to now take a look at our accelerated portfolios to financial freedom. There's two different portfolios. One's the accelerated and the second one is the super accelerated. I want to give a warning about these two portfolios coming up. They are very aggressive. First of all, they can go up fast is what you're looking for, but they can also go down fast if the market's turning down. Second of all, you need to be a high risk tolerance person to want to invest in these types of funds. Here's the first fund in the accelerated portfolio for financial freedom, the Fidelity Blue Chip Growth Fund. We're using that again as 60% of the portfolio. The next 20% is the Fidelity Select Technology Fund. Last 10 years, up 18.67%. Here's the breakdown for the Fidelity Select Technology Fund. Year to date, down 21.77%. The beta is 1.20, the largest that we've seen so far, and expense ratio is 0.67. The top 10 holdings make up 59.4% of the total assets, and you can see there's some large blue chip technology stocks. The third fund in the accelerated portfolio is the Fidelity Select Semiconductor Fund. Last 10 years, up 24.07%. Now here's a breakdown on the Semiconductor Fund. Year to date, down 23.83%. Last 10 years, up 24.07%. The beta is 1.35, much more aggressive than any of the funds that we've taken a look at. Expense ratio 0.68. The top 10 holdings make up 59.4% of the total assets. And you can see some of the names of the semiconductor stocks that are included. When we look at the overall makeup of the accelerated portfolio, we got 60% in the blue chip growth, 20% in the select technology, 20% in the select semiconductor. We're going to take a look at this super accelerated portfolio. We're going to look at the funds that make this up, and I'm also going to give you some ideas on how I would monitor this when I invest in. Here's a look at our makeup of our super accelerated portfolio. It's made up of 50% of the Fidelity Select Technology portfolio and 50% of the Fidelity Select Semiconductor Fund. Now again, these are very aggressive funds, but as you can see over here to the right, they also have very good returns to the upside. Also remember, you don't have to have 50% of your portfolio in these two funds. If you wanted to just use a portion of this in your portfolio, that is perfectly acceptable. Here's a weekly chart of the Fidelity Select Technology Fund. This goes back about 5 years. This red line here is a 65 period exponential moving average line. We use this as a guardrail. Up above is we have the RSI reading. We're looking at the red line primarily on the RSI. It's set to the RSI 30. Since these funds are so aggressive, if the price is above my moving average line, I would stay in it. Also, you can see the RSI 30 line breaking below the 50 line. So if these two things happen, I would not want to be in this fund on the way down. It moves too fast to the downside. We're now looking at the weekly chart for the Fidelity Select Semiconductor Fund. You can see it spends most of its time above this 65 period exponential moving average. But again, if it starts dipping below, then I would consider moving to cash. Again, when the RSI red line moves below the 50 line, I would also use that as one of my indicators to move to cash in these highly aggressive funds like this and the technology fund. For the majority of investors out there that are building their retirement portfolios over time, any of these three funds are excellent to use. If you wanted to be a little more aggressive, then you could add more of the aggressive funds. It's very important to understand your own personal risk tolerance. And also, it's important to understand the type of fund you're investing in. So I hope you found this video helpful. If you'd like to get information on the top Vanguard funds to build your retirement portfolio, click onto this link. I want to thank you for watching. Stay tuned for our next episode.